Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. This week, Ryan and I welcome Tim Wallen, CEO at MLG Capital, and Rick Reuter, Controller at MLG Capital, to discuss Tim's journey into real estate with MLG and why now is a pivotal time to invest. We also discuss the challenges investors face when transferring real estate to the next generation and strategies for minimizing taxes in the process. And finally, we jump into how funds like MLG's Legacy Fund can help minimize income and estate taxes and offer practical solutions to common challenges with tax-deferred investments. If you liked our previous episodes on 721 exchanges, you're going to love this one too, and we're going to dive into all that in just 1 minute. Hey, Tim, Rick, thank you so much for joining us today. Tim, I know you're a CPA. Would you be able to tell us a little bit about how you got started in real estate?
Sure. Quite a while. Back in 1985, 86, I graduated from college, master's in tax, and I took a job with Price Waterhouse out in the San Francisco office. And I was in the small business group, which grabbed all the real estate companies. So I just by default landed in the real estate business. And then in 1989, I joined MLG as their CFO back in Milwaukee, Wisconsin, which is my hometown state. Then I took over, I joined them as a CFO in 89. And then 2000, I became the CEO. So I've been in a leadership role now for about 22, 23 years. So about 35, well, I'm up to like 37 years, doing this real estate thing and always been very tax focused and everything that I do.
There's a lot of options out there a lot of things you probably could have joined. Why did you choose to join MLG? What makes MLG so unique?
I've always been kind of an entrepreneur. As a young kid, I was shoveling snow, cutting grass, all that kind of good stuff. So I like the idea of making money. And the benefit of being in the real estate space is, you create value for you and your family and your coworkers and friends and partners, and you create long-term revenue streams. So it's a great industry to be in. It's been a real blessing to be in the industry and really enjoyed my last 35 years doing it.
That's awesome. I know today specifically, we're still early in 2024. It's early February. A lot of people are unsure of whether or not they should invest today or not, given the current environment that we're in. Why would someone want to invest today?
We have a philosophy at MLG of investing through all cycles. And today, we're seeing some of the best cap rates we've seen in multiple decades. We have the least amount of competition on the buy side that we've had in 20 years on the buy side. Certainly back in the post Great Recession, the 2009-10 timeframe, was also a great buying opportunity. But and then also maybe in the late 80s when I was first in the industry. But this is one of the few times in the last 3 decades that you've had limited competition on the buy side. The big institutional players, a lot of them are on the sidelines and not investing today. They have asset allocation issues where the bond portfolio got hit by interest rates going up. So they're not putting fresh capital in real estate, they're putting the fresh capital into the bond bucket. And it just creates less competition. Many of the syndicators out there are struggling to raise capital because they had issues, and certainly a lot of challenges with the floating rate debt that occurred over time. So just a low number of folks that we're competing against, and a great opportunity buying.
Gotcha. I think that clears up a lot because there's been a lot of confusion out there whether or not people should be jumping in or not. And it seems like the environment actually opens up some opportunities. So I know MLG has a bunch of different products out there, a bunch of different ways they can help investors invest in this type of environment. What is the MLG Private Fund series and how does that benefit investors?
So maybe I'll just step back for just a second and give you a little explanation on what kind of makes us unique as a firm. And a lot of guys put real estate funds together. One of the benefits of funds, you get a diversified base of assets. And you're not just investing in single assets, getting away from single asset risk. But one of the arts of our business is how you find opportunities to invest in. And we call it our dual sourcing strategy. And this is where, we find assets on our own to buy, but we proactively invest with other real estate operators all over the country. So we have over 2,000 relationships where we do that. And to give you an example of that, take a market like Minneapolis. We have 60 or 70 different real estate companies we call about doing their deals. Say, hey, Joe, real estate guy, I got 20, 30 million in the investing market right now. What do you got going on? So we see a lot of opportunities from other real estate operators. We see roughly 100 opportunities a month from other operators. And we're looking to invest in 1 or 2 of those. So it's a critical selection process overall. And it's almost like we're the Southwest Airlines of the space, in that we're approaching our industry in a very different manner compared to our competition. And, most real estate guys, they find deals and then they go raise capital, from the investment community. And what we do is we go raise capital from the investment community, and then we go chase real estate guys trying to find the best deals possible. So it's kind of reversing the process of how our industry works. But then on top of that, we're this vertically integrated real estate company, and we own and manage roughly 40,000 apartment units, 900 employees. We have a deep bench of talented people that know how to buy assets. So about half of what we do is we buy assets on our own with our own long-term 30 years of relationships. And then the other half of what we do is invest with other real estate guys. So it just gives a great mix in our funds, where it's a blend of deals we find on our own and deals that other operators find, because it's just a part of the art of this business is finding great, smart deals. So, and then on top of that, and you guys will love this one, on top of doing great, smart real estate deals, every time after you buy a deal, you got to do great tax planning. And we're very, very focused on how we save money and how we reduce the tax bill on all of our funds. Nobody's experienced ordinary income on a collective basis is cumulatively cap gain income net. And, we're very proud of that. And it's very important in improving all in after tax rates and returns.
Awesome. Thanks, Tim. And I know Tom and Tim, you guys could probably have an entire podcast episode by yourselves. But maybe to include Rick here as well. Rick, would you mind just giving our listeners a little bit about your background, getting started with MLG, similar to Tim? Kind of give us some background on you first, and then I'll dive in for some questions with you.
Yeah, sure. So from Wisconsin originally, currently work here in Milwaukee. Went to UW-Madison, kind of big into kind of the tax side and the tax classes there. Actually started my career at Deloitte in Chicago in the external audit space. A lot of focusing on, hedge funds, mutual funds, broker dealers, kind of the fund structure in there. And then circled back to the homeland here in Milwaukee, jumped on with MLG in 2014 and really dove into the tax side of real estate, where, there's a lot of interesting strategies that we implement here to, like Tim mentioned, enhance after-tax returns for investors.
Awesome. Yeah. And obviously, we got lots of tax questions for you guys. Maybe for you, Rick, if you could just maybe tell our listeners who might be curious, can you invest, with a retirement account, and kind of talk about that as far as your guys' funds and things like that, retirement accounts?
Yeah, absolutely. So our private funds, there's two options for investment. One is the main fund. That's a direct pass-through partnership. And that's where most taxable investors will invest to take advantage of beneficial taxable losses. However, there's another side, the dividend fund side, that feeds through a subsidiary or REIT, and that allows tax-exempt investors, including retirement accounts, to invest without running into unrelated business taxable income UBTI issues.
As far as kind of the funds that you guys do and the tax structuring, some of those tax considerations that you have, talk about like a cost segregation study and kind of pulling that in.
Absolutely. Yeah. For the closed-end funds, cost segs are huge. One of the main strategies is creating beneficial ordinary losses that we can then pass through to investors. And in year one, typically we're able to get roughly 50 to 60% loss allocation as a percentage of capital contributed. And as you noted, cost segs are huge. Breaking up the acquisition of that property into hundreds of different assets, allocating as much as supportably possible to shorter class lives, which will accelerate depreciation deductions, including, increasing the amount of potential bonus depreciation that we can take. But in addition to that, we'll hit a lot of value add properties. We'll do CapEx improvement work. So we're making sure that we can expense as much as possible while still falling under the uniform cap rules. Involves a CapEx analysis as well as expense selections. And then the other thing I guess I'd like to hit on kind of the closed-end tax strategy is really the sales side. So sales strategies include timely sales as well as sales price allocations. So timely sales are important because they add passive 1231 gains into the investor's tax picture, and that can be very beneficial. Those passive 1231 gains can release prior year passive ordinary losses. And when those are released, those ordinary losses can help offset other ordinary income that investor may have. And that can shift most of their taxes into the capital gain rates. So this is a great investor after-tax IRR benefit. In some cases, we've seen roughly, 1 to 2% increase in after-tax IRR due to that hidden benefit. And the other side of sales is really being strategic about sales price allocations and making sure that you're mitigating or eliminating as much ordinary recapture as possible.
Yeah, I think a lot of times the tax aspect of a return on investment can get lost. Not to everyone, for sure, but sometimes it's good to bring in that aspect, especially with you guys understanding this space, being CPAs, things like that, kind of tying that in. Super important for you guys is just kind of selling and getting investors kind of what they're looking for with those passive losses, offsetting passive income, or if they're real estate professional status, obviously that can have a different impact. That's extremely positive for them as well. One other question for you, Rick. So within like your guys' diversified private funds, do you guys offer a composite K1?
So we don't file state composites because typically it results in investors paying way too much tax and it reduces their after-tax return. So composites in general subject investors to paying state tax at the highest rates on gross income for that investment for that year. So you're not only paying the highest rates, but you're losing the benefit of prior year losses, and you're losing the benefit of losses you may have from other investments in that state. Further, investors' resident states may not allow a credit for taxes paid to other states if that tax was paid in a composite. A lot of states don't allow investors to be in a composite if they have multiple investments in that state. So some funds filing these composite returns may not even be in compliance. We do have a solution, though, for kind of the multi-state tax filing burden that comes with diversified funds, and that's to invest in the dividend fund side. As a subsidiary REIT is going to block multi-state tax filing obligations for investors on that side.
Before we go any further here, just to kind of recap, because I know there's a lot of people out there who are investing as an LP. They may understand what a composite return is. But for those who are new or perhaps never invested as a limited partner before, a composite return, basically, it's when the partnership, or in this case, perhaps the fund, they're filing a state return on the partnership side on behalf of their partners. So then the limited partners and all the partners really in the deal do not have to worry about filing state K1s with their company. However, like you said, there's a lot of downsides to doing that. For that reason, you guys chose not to do that for these funds.
Yep, correct.
That makes a ton of sense. So, shifting gears a little bit, again, there's a lot of different funds that your team has available. What is the MLG Legacy Fund and why create it?
So just to differentiate, so we have our MLG private funds series where we roll out a new private funds, which are closed-end funds that usually have about an 8 to 10 year life. And we typically, like the current fund's $400 million. And we'll roll out a new fund like that every 24 months. But it's not a perpetual fund. We go buy 25, 30 assets, create value, then sell them off, and then that fund is done and goes away. The legacy fund was referred to as an evergreen fund. It means it goes on in perpetuity, but it's a very specialized fund with a specialized focus, and you can't take cash investments into it, but primarily it exists as a wealth transfer strategy, and it's about how do you move wealth from one generation to the next if you have appreciated real estate, and how do you do that in a manner that's most tax efficient and adds the most benefits to the family. I've seen a lot of mistakes made in my career where people try to move wealth to one generation to the next, or they don't do any planning and then they just give it to the kids, and then the 4 or 5 years are fighting over these assets, and what was meant to be a blessing to the family ends up being a curse, and the kids up in a lawsuit fighting over what to do. Do we sell? Do we not sell? Do we improve? Do we not improve? And it creates lots of problems because you have different heirs. They all tend to have different objectives in life. And it can even be the two real estate guys, the two real estate sons. They don't agree on what to do. And it creates friction and problems in the family. So this is a structure that deals with people who have made material wealth in real estate over their life. We have $1.2 billion in assets. We opened up this fund 2 years ago, and we already have $1.2 billion in assets have come in. And in this structure, it's referred to as another way to refer to as a 721 contribution fund. And 721 is an IRS code section, which basically allows the transfer of assets into a partnership and have that generally be tax-free. As long as the basis exceeds the debt, it generally should be a tax-free transfer into the partnership. And so by doing that, I'll use an example, and I'll make it named Bruce. Bruce and his wife had one large apartment complex. They sold a bunch of stuff, kept trading up to bigger properties, and all of a sudden they have 200 apartment units, and they're 70 years old, and it's also worth like $20 million. And maybe they paid their debt off over time, but yet what happens is in this example, and this is a real life example where a gentleman would not travel with his wife because he wouldn't leave his property. So the burden of asset management is real. And the husband wouldn't leave. The wife wants to travel. And he says, honey, we're not going to go. We got to watch over our asset. And the husband's like, we got all this money. We can't. What are we doing? We're trapped by our property. I need a solution here. And so in this structure, when you contribute an asset to our fund, you get the value of your asset. You get away from asset management. We take over the asset management on that property. And now instead of owning one asset, you're part of a basket of assets. So right now the legacy fund's $1.2 billion in assets. So instead of having 20 million in one asset, you got 20 million in this basket of 1.2 billion in assets. And we do that hard living, heavy lifting. Again, we manage roughly 40,000 apartment units. We have 900 employees. We know how to do this thing, and we take away that burden. But it does many other things. It brings diversification to the family, getting away from single asset risk. Now you're part of a portfolio of assets overall. It also brings in a strategy to actively grow NOI, to create value for the family. A lot of families, they get very content. They don't push rents. They don't improve their property. They don't look to create value. They want to make it as easy as possible. So they tend to have the rents below market. They brag about being 99, 100% occupied, but they're doing nothing to grow the value of their asset. So again, diversification, get away from asset management. In our fund, none of our people who have contributed assets so far are paying a dime in income taxes. Another situation, there's a gentleman, two partners, 30 million of equity. Their annual tax bill is about $750,000 a year. Since they've done the structure, their tax bill is zero. Not a penny in taxes has been paid since they've done the structure. So, again, the art of not paying income taxes in real estate is never stop buying, never stop investing. But the reality is you age up, you don't feel like it. Or maybe you're another guy, 60 years old, he wants to go on the beach, go play golf, go have fun. And he just doesn't want to work as hard as he was for the last 25, 30 years. And all of a sudden what happens, you do that, you start paying a bunch of income taxes because you're not actively investing. So we proactively have a strategy to reduce and eliminate ordinary income as much as possible. And then from estate tax planning, not everybody will understand that, but there's something called a minority discount. When you go from full control on assets and then you become a minority partner, you now have a lack of control discount, a valuation discount, because you don't have full control over those assets. So something that was worth 20 million, I use another example, two guys, about 100 million each, but $100 million estate situation, by contributing the assets in, that value instantly goes from 100 million down to roughly, it depends on the facts and circumstances, but let's call it 30% discount. Something goes from 100 million down to 70 million. It's a typical discount you have. And also I eliminate 30 million of your estate, and that also saves you 12 million in estate taxes if you have a taxable estate and you haven't done all the other planning. But then there's some really cool things you can do. You can sell those interests to a slat for your kids, and do an installment sale, get that value out of your estate in its entirety. There's a ton of planning opportunities. So, reducing income taxes, reducing estate taxes, getting away from asset management, creating diversification. And that's what the Legacy Fund's all about. It's about a permanent solution to deal with how do you move wealth to the next generation and giving flexibility to the heirs. And we have liquidity vehicles that if one heir wants cash, we can provide cash. If one heir wants a tax-deferred solution, we can do that. And again, lots of different things we can do and lots of flexibility. So it's very dynamic. And, we've had multiple families take their entire portfolio. You think about that emotional decision. You spent your whole life building up this portfolio and you contribute it to this fund that we manage for them. And you think about the level of trust that you have to have, the level of confidence and the benefits that it's bringing to the family. And so just that alone is testimonial to why and the effectiveness and the power of the structure. And it's commonly not done in our industry, and I have a lot of reasons why it's not done. It's very complex to administer. We have 12 CPAs on staff. Not many real estate firms have 12 CPAs on staff. Rick on here is a total stud, and he knows a ton about the stuff. But we've also partnered up with other groups and whatnot, and the complexity of this. So it's been vetted and very powerful benefit to families in their life planning.
That's awesome. I know people are always looking to exit their properties in a tax efficient manner, and this seems to be one way to do so. There's a lot of great benefits to doing that. What problems do you see with these type of popular solutions in the marketplace today?
When people are looking for long-term solutions with wealth creation in private real estate, what's happened in the past commonly, and I'll go back to my Bruce example. Bruce was going to sell his apartment complex and buy a triple net medical office building with like 10 years left on the lease. But the problem with the triple net product is you tend to overpay on a price per square foot basis. You're taking single credit risk, and you have a lease term that's declining from the day you buy it. So the day you buy a triple net asset, the next day it's worth less because the maturity of the lease is shorter and shorter. And you're seeing today in Walgreens across the country, Walgreens actually closing locations. Walgreens were all sort of, never could lose if I bought a Walgreens. But it has some real traps to it from a credit perspective, from a value perspective. In general, I think there's real risk of losing your equity. So you solve your asset management problem by buying a triple net deal, but you created new problems and risk of losing capital, losing value. Plus, you generally create ordinary income taxes. If you look at most triple net deals and you go out 10 years in a lease term, and you're amortizing debt, your after-tax cash flows go to almost zero because of you're paying down debt, and it's very problematic. Another thing, people might trade into other assets, and you just get lack of diversification and overall. Another common tool is DSTs, Delaware Statutory Trust, where people trade into those. It's a newer product that's certainly got a lot of legs in the last decade. The problem with DSTs is it's not a permanent solution. When you trade into a DST with your 1031 proceeds, at some point that DST is going to unwind and you're going to have to trade again. So if you're 70 years old and you do a 10-year DST structure, 10 years from now when you're 80, you got to trade again. And maybe you're not even around. Maybe you're not doing well and it's going to be difficult for you to do that. So it's not a permanent solution. There are some things that can be done there. You tend to have monster fees. You typically are giving up 200 to 300 basis points a year in fees, heavy fee beats overall, and generally very limited value growth. It's very difficult to capitalize any kind of value add strategy in a DST. So the ability to create value on your equity is very limited in the DST structure. So again, the legacy fund was created as an alternative to these products because it doesn't have the same challenges. There's also a common thing with people trade in tenant common structures, and they have a piece of the deal. Tenant common structure is one where they're buying an asset and maybe it needs 20 million of equity, and you split that 20 million of equity into, say 5 pieces ranging from $2 to $10 million per piece. And what happens there, to have it work under the tax laws, each tenant common member needs to have a certain amount of control and power. Now you have what I call a corporate governance problem, that now you have multiple people that you may not have that big of a relationship with having a say in what to do in an asset. And what if you disagree? And again, you have different goals and objectives, and it creates real problems, overall. So I'm not a big fan of tenant common structures unless you can control the management of each of the tenant common members. I'm not a big fan of tenant common structures overall, for families overall. And then probably another last common scenario is UPREIT structures, where people contribute their value of real estate. I know an example, I won't use the name, but the group contributed roughly $300 million of real estate into a publicly traded REIT. The REITs are down 40%. Multifamilies are down 40% in the last 2 years. That doesn't feel too good because you have a lot of volatility. Public REITs have a high correlation rate to the S&P 500, whereas private real estate has a very low correlation rate to the S&P 500. So the volatility in the stock market, REITs go up and down more dramatically, and private real estate, tends to be a lot less volatile. In fact, private real estate proved its worth in this cycle. You get a lot of rent growth to offset the impact of higher interest rates overall. So, public REITs have real problems. There's all the REIT compliance issues. You can't sell for you can't sell for 2 years once an asset comes in. They're not structured to eliminate or reduce income taxes. They don't do bonus depreciation. Everything's straight line depreciation for the public reach. So they're not looking to eliminate your ordinary income. And again, so it deals with a long-term asset management solution. It deals with diversification to a degree, but now you got single stock risk. So, I'm not always the best fan of that. So anyways, there's solutions out there for how do you move wealth to the next generation? How do you get away from asset management? And we think the Legacy Fund really tackles the complexity of how you move wealth from one generation to the next.
No, that makes a ton of sense, and we've explored a lot of these opportunities here on the show, and there's pros and cons in all of them. And at the end of the day, there's a lot of reasons why people want to go passive, right? There's asset management issues, there's property management issues. In some cases, people are retiring. Sometimes it's simply age. Maybe it's issues with the family. With all these different reasons why someone might want to go passive, what would you say is like the number one reason out of all these reasons why someone might want to go passive?
I think getting away from asset management and going to enjoy life, like my Bruce story, his wife wants them to go travel and have fun, is probably the biggest reason. The people are getting old and they realize that they're not going to be able to do this the rest of their life. They don't have kids in the business and they don't have a solution for asset management that goes on for the balance of their life. And so I'd say asset management is number one. The taxes are certainly not far behind, but asset management is definitely number one.
Absolutely. I'd say it's probably from my experience, just what I've seen working with clients in various stages of their life. Usually it's the asset management in some way, shape, or form that ends up burning them out and wants to drive them a passive. And I understand that. I know we're going to dive into some more of the taxes here in just a second. But I one of the reasons why I've seen people be hesitant, especially lifelong landlords, jump into something like this is control. So for the people who are used to being in control of their portfolio, control of their assets, and are now going to take this more passive jump, what do you say to those folks?
Well, do I look at it, we all want to live forever, but God didn't wire us that way. Most of us, go on to the next stage of a life in eternity. And, 85, somewhere between 80 and 90, you start losing it. You don't have the ability to do this. And so you have to answer that question. You can have control. And we have many folks that are on the sidelines, but I like the structure. I don't have a kid to hand this to. I don't have a solution for asset management, but I'm 77 years old and I like having control and I'm just not ready. But the reality is sometimes, God doesn't give us a time clock to when we're going to go. And you're leaving a real problem for your estate and your family. And at some point, you got to bite the bullet and have a plan. Whatever it is, have a plan. Doesn't have to be MLG and Legacy Fund. Have a plan on how you're going to move this asset for the next generation. You're also, if you don't plan well, the government is now your beneficiary of your estate. There's no reason why you can't move material wealth to one generation next. Work with you, Tom and Ryan, and you guys can do some great planning for families. There is no reason to pay material estate taxes. And if you have any time to plan and get ahead of this, you should not be paying material estate taxes. But you just got to get together with Tom and Ryan and do that. It's just so simple, but it's so silly. And unless you like the government and like giving your money away, I don't know why people don't plan. It just baffles me. But actually, I know the reason why. They don't want to give up control, and it's that control issue. But at some point, you have to figure that out. You just can't ignore it. It's not going away. It's like a bad tooth that you got to yank out. At some point, you just got to do it and you got to figure it out.
Yep. Yeah, it's tough to give up control when you've had control for decades over your assets, but it's good to have a plan because at some point you've got to give up control of that. Whether you do it voluntarily and you make a plan for it, or you're giving it to your kids, and ultimately that's giving up control as well. So absolutely. Maybe Rick, I can come over to you for a question. So let's pretend I'm asking for a friend. I've talked about this on a different podcast. Let's pretend I am selling a fourplex. Okay. Could I say I've got a $100,000 gain that's going to be associated to my name? Could I, for example, come and invest into your guys' legacy fund and minimize tax, estate taxes, any of that? How would that work as far as kind of that fund, and if I were to do something like that?
Yeah, so the legacy fund now, very complex vehicle, a lot of complex structure in there. So we do have a $3 million equity minimum to go into the legacy fund. But once you're hitting kind of the minimums, absolutely. Anyone is really able to feed into the fund. whether that's a direct property contribution, a 1031 escrow, or even an asset that, needs to be sold quickly. Those last two fact patterns, we would mix in a 1031 exchange along with a 721 contribution. And it really depends what legal structure you're in. If it's directly held as an individual, it's going to result in a 1031 in a quality replacement property that we'll source, and then a contribution at a future date once investment intent is met for 1031 purposes. If it's a multi-member entity, we can kind of match up a 1031 exchange with 721s of partnership interest, but making sure that partnership remains intact for 1031 purposes. So at the end of the day, there's absolutely, you can enter the fund, get that initial tax deferral, as well as the year-over-year tax savings. But there is going to be a materiality concept with a fund like our structure and minimums that we're looking to hit.
Yeah.
Yeah, the reality is you're probably better off with the small checks with the DST structure. But I would look at a DST structure that gives you the ability to convert to a partnership structure that's diversified after a 2-year window. The downside of that structure is that they don't protect your value. So if the values go down in between and the single asset they trade you into, you have no protection in the DST world for that 2-year period of value drop. Whereas ours is a solution that you can do immediately. But again, smaller checks, DSTs do work well for smaller checks.
Okay. So people could we kind of talked about 1031 exchanges. So people could do a 1031 exchange into the legacy fund, it sounds like.
So the legacy fund is a partnership interest. So you cannot directly 1031 exchange real estate into that partnership interest. If it's held by an individual, it's really going to be a 2-step process where you're doing a 1031 exchange, and it can be into a managed account that MLG kind of runs as an asset manager. But that entity has to hold that replacement property for investment intent. We see safe investment intent hold period as roughly 2 years. So 2 years kind of in that replacement property and then a subsequent contribution. However, what I said before, if you're a multi-member, there's a lot of flexibility in there because that multi-member entity can do that 1031 exchange, and the partners that are in that multi-member entity simultaneously with that 1031 exchange, they're able to do 721 contributions of their partnership interest to the legacy fund.
Got it. Okay. I might have missed that part with the 1031 it being a partnership. So thank you for clarifying that. Maybe you guys can kind of briefly, obviously we're talking to a bunch of CPAs, which we don't normally get all CPAs on here, but for people who are very curious about some more of the tax aspects, maybe you guys could just talk about the legacy fund still, kind of the tax considerations there, kind of that structure.
Yeah, sure. So for the legacy fund, maybe I'll hit kind of 3 major buckets of benefits. And one is, full tax deferral upon contribution of property to the partnership in exchange for partnership interest in accordance with 721A. So that qualifies for non-recognition of your built-in gain. The second bucket is what's your year-over-year ordinary income tax picture looking like? As Tim alluded to previously, there's a lot of people that are holding real estate. It's depreciated. They're cutting ordinary income tax checks over the government year over year while holding that depreciated real estate. But what the legacy fund does is it's going to take any kind of proceeds that it could potentially lever up or properties it's buying up in 1031 exchanges and create fresh basis. When that fresh basis is created, it'll use similar strategies to the closed-end fund that we talked about to accelerate deductions. So the first 2 years of the fund produced nice ordinary loss allocations to investors of 8% and 7% respectively as a percentage of contributed capital. And these are low basis assets, again, feeding in that qualify for full deferral. So that's why the losses aren't amounting as high as the closed-end funds, but still very beneficial, getting cash and getting loss allocations. The third bucket is really the death tax benefits. So an investor is able to achieve permanent built-in gain tax deferral via step-up in basis at death, and it can transfer over to the heirs. In addition to that, the legacy fund has a 754 election in place, which is going to create additional tax assets for the heirs. So the heirs who wish to continue to hold can get additional depreciation deductions that will feed back to them, just them, that can help shield kind of their ordinary income tax picture.
Awesome. Yeah, thank you for highlighting that, Rick. There's a ton of aspects to that. And obviously, I'd say the common thing that we talk about on our podcast is deferred, 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 die. As a common kind of really long-term strategy, I'd say it's probably the longest term game strategy that real estate investors specifically can be using. So getting that step up in basis, especially if you can defer the tax just a long time, huge strategy, I think, for a lot of people. It's almost too far into the future to conceptualize, and they find it hard to actually execute on that. But absolutely, that's a key part of, I think, this fund that you guys have that can be a great solution for clients that you guys have, we have, in order to reduce that tax and therefore give more to their heirs and beneficiaries. So that's great.
All right. So kind of rounding some things out here. I know we're kind of getting towards the end here. Any final words or any final things we'd like to mention for the listeners who might be considering jumping into a fund like this legacy fund to defer their taxes?
My main message to everybody is just do your planning. We talked about that earlier. Don't hide from it. It's like even problems in life, you got to run right at it. You can't run away from it. It's going to run you over from behind. Pick up the phone, call Tom, call Ryan, figure out what you're doing. And the tax man will get you if you don't plan, but if you plan, you can avoid it. And unfortunately, the ultimate tax planning strategy is death. You want to defer, and then you die, and then you get a basis step up. That is the ultimate tax planning strategy. And it's not always fun to talk about, but that's reality for all of us. So, I really encourage people to step up and grow up and do your planning, and then you're going to have to give control someday if you want to do that. Now, if you have kids in a business and you want to give it to them, then do it. I mean, a legacy fund's not built for somebody who wants to transfer the wealth to their family and they want to stay in the real estate business. It does work if you have multiple layers and one family member wants to be in the real estate business and the rest don't. We can work with that fact pattern. But if you have your family and cohesive unit that wants to keep a real estate business going, then keep control. But again, you still want to plan on how you're going to move that wealth to the next generation. And I just can't stand the idea of giving the money to the government versus giving it to some great foundation to help kids at risk, or give it to your kids, or whatever your passions are. There's no reason to just give it to the government so they can spend it on crazy stuff that they spend it on. But I much prefer to see it used more wisely than that.
No, I couldn't agree more. I could not agree more. If our listeners out here, if they're maybe considering a strategy like this and they want to learn more about the MLG fund and perhaps how your group can help them facilitate a tax-deferred strategy like this, what's the best way for them to get in touch and go through that procedure, or learn more rather?
Yeah, I mean, there's a couple approaches. I mean, one is, we certainly have our website, mlgcapital.com. The letters is like Mary, Larry, Gary. It was called the Moonless Age Group, but mlgcapital.com, and then a /legacy if you want to jump right to the legacy fund. But, you can look at our website, check things out. Andrew Evanich at our firm is one that's kind of a first contact for a lot of people. Andrew's, actually, I can give you his numbers. Andrew Evanich, 262-957-6784 and 262-957-6784. And it's Andrew Evanich. But anyways, we have a whole team, and, eventually most people that work with us, they're going to be eventually talking to Rick as well, and Billy Fox and others, and Tom Pugh. But again, we have 12 CPAs on staff that help people through this, help them through the mathematics of it, help them through the emotion of it. This is an emotional decision when you're making some of these decisions or long-term keep planning things. And we've certainly had a lot of experience, a lot of families, and even partnership situations. We had an entire real estate company can contribute their entire portfolio to us. We had one group, 200 million in assets, multiple investors, multiple partners, and they all were done, and they wanted to be done. And the solution not only gave the real estate sponsor a tax-deferred solution, also gave all their investors inside their firm a tax-deferred solution. And now every individual within that group can go do what they want to do. So anyways, that's probably the best way to get a hold of us. I'm always available as well, and more than happy to talk to people and help them through these big decisions in life.
No, absolutely big decisions. So we're gonna go ahead and drop that into the show notes below for everybody who's listening. If you do want to check that out, if you are doing some exit planning, you're doing some long-term planning for yourself, this is certainly a viable option. So Again, we'll drop that in the show notes. Tim, Rick, want to thank you for joining us today and sharing the strategy with our listeners.
Well, thanks, guys.
Thank you.
Appreciate your time.
That was another tremendous episode. We love MLG. We brought them on because, we know, if you've been a long time listener to this show, you are always looking for ways to reduce your taxes. And on exit is usually when you're going to pay sometimes your highest taxes because you're going to hold the property for however many years. Maybe you force depreciation by using a value add strategy, and now you're going to have this big gain. And your question is, well, how do I get rid of this gain? Of course, there's the 1031 exchange where you defer your taxes by purchasing a new property and rolling your sales proceeds in from your original property into this new deal, into the replacement property. And then there's the lazy 1031 exchange where you use passive losses to offset the capital gain on sale. And you're getting those passive losses either from that property perhaps you had in previous years, or perhaps from other properties in the current year, or even prior years from the suspended losses. So those are kind of two popular strategies. Now, when you start to want to get into not managing property anymore, your options become a little bit more interesting. So the way that works is, so if you're going to use a 1031 exchange, just a pure vanilla 1031 exchange, you're going to sell your property, you're going to identify a replacement property, and you're going to acquire that property within 180 days. And then you're typically going to be the one responsible for managing that property, or maybe you have a property manager, but nonetheless, the asset management will ultimately fall on your shoulders, that responsibility for that property. And same thing with the lazy 1031 exchange. You're going out and buying another property. The good news is with the lazy 1031 exchange is you can invest into a syndicate or fund that will give you passive losses in the year that you sell your property. That'll be able to help you offset that gain, right? Maybe the lazy 1031 exchange, there is an off ramp where you're not active anymore. But assuming these two strategies are not viable for you in some way, shape, or form, then you have to look at your alternatives. And one of the most popular alternatives, the ones that have been popular over the last few years, have been using a 1031 exchange to swap into what's known as a Delaware Statutory Trust, or DST. And that's usually when you buy this big property, an institutional grade property, usually a retail center like a Dollar Tree or a Walgreens, kind of like what Tim mentioned before. And now you're in this DST, but that does come with high fees, and it's not usually diversified. It's usually a single asset. So that could be an issue with the DST. But now we get into something called the 721 exchange, and we've talked about this here on the show. And long story short, what happens with a 721 exchange is you are exchanging your property, you're contributing your property into a partnership in exchange for a partnership interest in that partnership. So it's usually not taxable when that occurs. Instead, you will be taxed as you start selling off those partnership interests. Now, 721 exchanges, as they are typically structured, is going to be with a REIT. So it's going to be known as an UPREIT. And long story short, basically what happens is the REIT has a carve out for 721 exchanges where you'll exchange your property into this partnership structure, and you'll effectively have shares of the REIT. And again, as you sell off those shares, you'll start recognizing capital gains, and that's when you'll pay the taxes. Now, the issue with this is that in most cases, properties that these REITs will accept are going to be commercial assets, almost institutional grade assets in many cases. So if you have your fourplex or even your 32 unit or maybe 50 or even 100 unit apartment complex, it may not always meet the criteria of this UPREIT. So what happens is you can't just directly contribute your property using the 721 exchange into this partnership. Instead, you have to 1031 exchange into an asset that would meet the criteria of these funds, right? Of these partnerships. So for example, you might have your fourplex or you might have your 32 unit apartment complex. And instead, so what you do is you 1031 exchange it into, let's say, an industrial property, right? And this industrial property meets the criteria of these funds, whether it be an UPREIT or whether it be a fund like MLG's Legacy Fund. So what happens is you 1031 exchange into this commercial property, and then you later, after the property seasons, again, you could ask, it varies on what exactly, how long you have to hold it. But to Tim's point before, or Rick's point before, 2 years is usually appropriate for that seasoning period. And at that point, after you hold that asset for 2 years, now you're moving it into these funds. And the good thing about a 721 exchange versus, say, a DST is diversification, because in many cases, these UPREITs or these funds like MLG's fund are going to have multiple properties, usually in many geographic locations, perhaps even across asset classes. So you might have your 32-unit apartment complex, you then 1031 exchange it into this commercial property, and then that ultimately gets absorbed through the 721 exchange into this fund. Now you have a diversified pool of funds that you're invested into. And again, kind of like what they mentioned before, with these UPREITs, sometimes they're publicly traded and their values are tied to the stock market, and that becomes problematic. But with funds, when it's it's a private fund, you're not tied to the S&P 500. So if the S&P 500 tanks, your asset values may not necessarily go along with it if it's not correlated. So long story short here, the reason why we're doing this debrief today is because we know we went through a lot on the show. And you might be wondering, well, how does a fund like MLG's Legacy Fund, or how does any other fund of a similar nature help me from a tax perspective? And the bottom line is it allows you to contribute your property to the partnership, in some cases directly, in exchange for those partnership interests. And that's tax deferred. You'll start recognizing your tax as you start selling off those shares, assuming you don't get stepped up in basis and you die and do your estate planning and pass on those shares to your heirs. The alternative ways, if your property does not qualify for a 721 exchange because it doesn't meet the criteria of one of these funds or an UPREIT, you do a 1031 exchange into an asset, deferring your taxes. That does, and then that asset gets eventually absorbed by the 721 exchange, continuing to defer your taxes. And now, again, as you start selling off those shares, assuming you do sell them, that's when you will start recognizing that capital gain. So in a nutshell, it's kind of what we talked about today. And MLG's Legacy Fund is a mechanism for helping you do that.
Yeah, I was just going to chime in on two things, Tom. Try to keep in this debrief short. Number one, the 2-year thing. Right? A lot of people may, what's this 2-year thing? Just real brief, it's essentially just to show intent. Right? The 2 years is to show intent that this is for this 1031 exchange that we're doing. The intent is to complete a full-blown 1031 exchange. We're not just trying to say, hey, do this, and then a month later, I'm going to change that, right? The IRS could say, hey, was that really your intent to buy into that new property? So that's the 2-year thing, to show intent that this is a legitimate 1031 exchange. The second thing I was going to highlight was my question to Rick, which was like, hey, can I take my $100,000 gain and go, invest into this legacy fund? Well, there's minimums, right? And so that's why for some people, sometimes doing these legacy funds or other things like this is not a good fit for everyone, because oftentimes there's minimums. You have to invest so much in order for them to essentially accept you into accepting your asset or whatnot. So this isn't like, hey, I bought my first property, I'm going to sell it for, like I said, $1 million. I'm going to go do this. Probably not going to work. So my point is, the reason this isn't like talked about every single day on the podcast is because it's not relevant to every single person. It's relevant to a lot of people. The bigger the gain, obviously, the more likely that this is going to be a good solution for you. But point is, just be careful of kind of, how can I get into this? Does this make sense for me? It might make sense for some people. Doesn't mean it makes sense for everyone.
Absolutely. It's a great point. It's a tool in the tool belt. It's one of the many exit strategies you have available to you. And just remember, the earlier you start thinking about this stuff, the earlier you start planning for the stuff, the more options will be available to you. And I got to say, I look at real estate as a lifelong game. So I intend to be in real estate in some way, shape, or form until the day I die. What capacity that will be in will unfold before me. But if you want to pass down your assets to your heirs and you want to remain in control of your portfolio, then you really need to start thinking early on, how can I raise my children, right? How can I develop my children into the individuals? How can I develop their competency into one that can take over this portfolio? And hopefully one of your children's interests will actually align with that, right? You don't want to force somebody who has no interest in this whatsoever, including one of your children perhaps, into this if they don't want to. But assuming that you could see this coming, you could perhaps develop or raise one of your children to fit into the role to take over your portfolio. And then something like this may not be necessary. But the earlier you could see this, like Stephen Covey says, start with the end in mind. If you could see this coming 30, 40 years down the road, you have plenty of runway to perhaps make that happen. And perhaps that's not how you want to do it. And now you know another tool in your tool belt that can help you make this transition when that time comes. But what happens for a lot of people is they don't plan ahead. they get to the end, they get to their 70s and 80s, and they don't have any other viable options. And this becomes a very viable option for you at that point. You get to diversify your portfolio into the hands of a fund managed by a company with a great track record. And most of these companies who do offer these types of opportunities always do your own due diligence. If we don't say that enough on the show, you don't want to just take what you hear here on the show and go run with it. Go look into it yourself, do your own due diligence, speak to your own advisors, and make sure it makes sense for you. But again, just another tool in the tool belt. And I'm sure we'll be talking about estate planning, succession planning a lot more as time goes on. But again, just remember, the earlier you can start planning for this stuff, and I know it's a far way off for a lot of people, the more control you have in what options you have available to you. All right, so I think that's about it for today. If you do have questions on stuff like this, do join our Facebook group, www.taxsmartinvestors.com/Facebook, or go ahead and check out our insiders group where Ryan and I are always answering questions, and the rest of our team are answering questions from tax smart investors like you. That is www.taxsmartinvestors.com/insiders. We'll see you there, and we'll catch you on the next episode of the Tax Smart REI podcast.